as we get ready for the next group, I'd like to please thank the Grace Richardson Fund, one of the supporters of the AREDAY conference. Grace Richardson Fund, they champion conservative and free market optimism, pioneering original, cutting-edge, pro-capitalist proposals and new ideas that can bridge the gap between the left and the right, save the planet, and expand liberty and prosperity, all while making a buck. So thank you very much to the Grace Richardson Fund. So our next group of folks is going to be talking about something near and dear to my heart. When I got into renewables, I thought it was about electrical engineering, and now I know that it's about financial engineering and structuring deals and making sure that we can get the clean energy future that we all want is going to be one of the topics covered by this group. I'm not going to individually introduce everybody. I'm going to introduce the MC of the group. So I'd like to call up the moderator, Rod Eckhardt. Rod is from, oh, I'm sorry.
Hi, I'm Joel Serface.
Joel Serface, scratch that, is going to be the moderator. And he's going to be introducing all the members of the panel, and I'll just let him run with that. Thank you very much.
All right. Thank you. All right, so I like the framing of that. We're going from engineering to financial engineering. And without the finance available to us, we're not going to be able to build renewable energy throughout the world. So today's conversation is, what does renewable energy finance look like, and what is it going to take to get to 100% renewables? And we're very fortunate we have an amazing panel of members who have been innovators in their own respective part of what we call the renewable energy capital stack. And we'll explain that a little bit up front, but also explain how we think we're going to be able to grow the renewable energy economy in the United States and globally, what it's going to take. But before we get going, and before I introduce all of our panel members, I just want to throw out a couple of different points. One of the memes that a couple of the memes that have formed over the course of the conference are, we have a lot of bad news, and even though there's a lot of hope and optimism about where we're going, we still have to overcome the bad news issues. We have to end business as usual. We have to look at very big breakthroughs. And what I can say about renewable energy finance globally right now is we have a lot to be excited about. Renewables are winning. Last year, there was about $300 billion of renewable energy finance spread throughout the world. More than 50% of that was investing in renewables outside the developed world for the first time. So it's happening not only in the developed world, but in the developing world. That is happening at twice the rate of investment into any other form of electricity that's non-renewable, including hydropower and nukes. It is also it's helping achieve 10% of our global electricity supply, which is accelerating tremendously. And it keeps on getting cheaper every year. And so with all of that, and the progress we're making here in the United States, and the ramp up that we've seen over the last several years, what's it going to take to move it up to a higher level, to get to that 100% level? So let me introduce our panelists who are going to explain a little bit about what they've done to be able to get us to where we are today, which has been phenomenal. We've had the headwinds against us for a very long period of time in terms of competing against incumbent technologies and displacing them. But there have been a lot of backdoor wrangling and all kinds of policy maneuvers and lots of new financial innovations that have happened that these people have been able to create. So I'm going to start from this side of the panel all the way to the other and introduce Josh Herlands, who's with ORIX USA. And I'm going to let him start off by explaining what innovations he's brought to market and the things that he's working on in the financial stack.
Sure. Thank you, Joel. And also thank you to Rod and to the organizers of the conference. I really appreciate having the chance to come here. This is my first year. I guess many of you are veterans of the conference, and it's been phenomenal for me to be here as somebody from the finance world who's kind of used to going to conferences where we're surrounded by people in that world, kind of talking the same language, hearing the same things day after day. And it's been very eye-opening and wonderful just to have all these conversations that we've had in the hallways and outside about more macro level topics and kind of broader themes. So thank you to everybody for being so welcoming. to give you the 2 minutes on ORIX, we are essentially a publicly traded global investor, headquartered in Japan. We have about 100 billion in assets globally, 7 billion of which is in the US. We are a broad-based investor, so we invest in real estate, healthcare, transportation, et cetera. I focus on infrastructure and renewables, where we've made an increasingly large push over the last couple of years. We currently own and operate about 850 megawatts of solar in Japan. We have a stake in a portfolio of almost a gigawatt of wind in India, going to the point about renewables proliferating in the developing world as well as the developed world. And we've made a couple of marquee solar investments in the US and have been looking to grow that. And so we're excited to be in the, really excited to jump into the space. And I guess as everyone else will talk about, there are various kind of pieces to the renewable energy capital structure, as Joel teased up, and we play in many of those. So we have the ability to provide debt to projects as well as equity, and we are a US taxpayer, so we can efficiently utilize and monetize the tax benefits associated with solar and wind and other technologies as well.
I'm Rod Eckhardt, and I'm with Seminole Equity Partners, and we're fairly straightforward. We're an American-based firm, financial services firm that provides various debt products on renewable energy across the country. We're also a tax equity investor. We've been doing this since 2007, and as Joel was pointing out, we've been involved in a number of different transactions and structures that were unique at the time that have become mainstream. We won't get too far into the weeds on that because, frankly, a discussion on single tier versus inverted lease and code regs probably wouldn't be very interesting to most of you. But
there's a separate conference going on about that right now.
That's right. So happy to be a part of this panel and looking forward to the conversation.
Great. Thanks, Rod. Hi, everybody. I'm Joel Cohn. I'm a partner with Cohn Reznick, which is an accounting firm, and I'm pleased to be here today. It's again, my first conference, too. This is pretty exciting. So Cohn Reznick, as I mentioned, is an accounting firm. Roots date back to 1919. We haven't had a renewable energy practice quite that long, but we have a fully dedicated practice in a lot of different segments of the renewable energy industry. Where that's relevant to our discussion today is that myself and my colleagues see a large number of these transactions, these financings, and whether we represent any of the different stakeholders, so we have an appreciation for those stakeholders' perspectives, what's important to them, what their sort of hot buttons are, and what are the issues facing them today. And the industry and the financial aspects of this industry are clearly evolving. A lot of segments of the financial services industry are evolving, but probably not to the degree of the renewables. And I think that when you think about accelerating adoption, the table you set, Joel, I think we've got some road ahead of us as some of those sort of practices become standards and probably people are comfortable that they've reached sort of a point of optimality where additional evolutions or revolutions probably don't incrementally benefit the industry too much. But I think that opportunity is still ahead of us where there's still plenty of room for innovation. Where we are sort of trying to innovate is in those structures, understanding the individual stakeholders' perspectives and trying to sort of play a sort of 3D chess game of trying to move the financial engineering aspects of the pieces of the project around to achieve optimality so everyone will finance the project and there'll be another asset created.
Well, from one Joel to the other, this is the first panel I've ever had with another Joel on it, so thank you for being here. Let me say that Cohn Reznick is one of those players that provides intelligence, and he used the word optimality a number of times already, but in order to be able to take the complex and make it simple, we have to have professionals like Cohn Reznick at the table with us to be able to make that happen. So they've been a very important firm in this space in helping get some standardization around this. So.
Hi, I'm Matt Wright. I'm with National Cooperative Bank. We're a small member-owned bank headquartered in DC, offices in New York, Anchorage, and Oakland. We focus a lot on financing other cooperatives, whether it's a worker-owned co-op, a real estate co-op, purchasing co-op. We work in the healthcare arena, low income. I've been doing tax credits for over 10 years now, whether it was new market tax credits where I originally met Rod, and then since 2008 we've been doing solar. So what we really focus in on, we have a portfolio of probably over 400 megawatts of solar, did financed about over 100 last year. And what we really focus on are the 20 megawatts and less, and scalability, trying to work with the developer and putting together a dozen or so projects where we can bring the efficiency of the closing transaction. We really bring down the cost and scale out projects. So.
Very good. So thank you all for being part of this panel. I've got a big question I want to ask, but I want to ask the audience a question before I go farther. And I would like to gauge how many of you are familiar with renewable energy finance and what it takes to be able to build a renewable energy project. And I'm going to do this by show of hands. If you want to hear more about the nuts and bolts of how project finance works for renewable energy, please raise your hand.
Only because I have to.
Otherwise, I guess we're done, right?
All right, so
We're not very good at jokes, so.
All right, well, we were covering some jokes last night in preparation for this, but this is going to be our turbocharged question round, and I'm going to call it the gladiator style. And nobody has more than 1 minute to answer this, but starting from Rod, and then we're going to go to your right, and then back over to the left, and all the way back to Joel. We'll let Joel close this out. We're going to explain project finance and tax equity, and the next person gets to correct the last person. Go.
I'm going to just put, capital stack is comprised of a few different elements.
Capital stack, what is capital stack?
Capital stack is the money that it takes to get a deal done. There's construction debt, there's permanent debt, there's developer equity, and there's some people will call that sponsor equity, and there's tax equity. You take it from there. What maybe better would be is just roll through it rather than me dominate the conversation.
All right, Tag, you're it.
Oh, man.
What's tax equity?
So tax equity essentially came about because, as many of you probably know, a large portion of the value of solar projects is wrapped up in tax benefits in the form of the investment tax credit and also in the form of accelerated depreciation, which can lower the tax bill for whoever owns the project. Certain owners, though, can't monetize those tax benefits, right? If they're a thinly capitalized developer that doesn't have a lot of taxable income, or any taxable income for that matter, they can't use that. And so a market has developed for third parties to come in and provide that capital, which has been a very interesting sector of the space and a very important piece of the capital structure for renewables projects.
Matthew, what are these guys missing?
Well, they're missing the debt.
Which is what you bring.
Which is what I bring. This is where we complement each other. We focus on the project finance, which is basically taking a single project, looking at the contracts and the revenue coming from that project, and underwriting it and making a loan against those revenues, net of fixed costs. So under a minute.
That was very efficient. Joel, what did all these guys miss? I mean, does anybody understand project finance yet? Joel, can you bring it home?
I will do my best. So, tax equity. So I think the way to think about this is that Congress created these incentives for ownership of these assets. And these incentives cannot be separated from the ownership. So as a result, if a big company has a tax liability that it wants to reduce and it's willing to invest in these projects, maybe get some cash flow and also enjoy the tax benefits, that big company needs to become a co-owner of that facility. And once you touch the Internal Revenue Code, you're subject to the entire Internal Revenue Code. And that's where the complication enters, because that structure, that ownership arrangement, that joint venture, that partnership is subject to all the technical rules in the Internal Revenue Code, and that's where all the pocket protector people, the accountants and the tax lawyers, get excited and add their value. So I think that's the essence of the complication of tax equity, is that tax benefits cannot be separated from ownership, and that's something some newbies just certainly come to learn. The other thing about the tax equity is and the capital stack is because you're introducing a new owner of the project and a new stakeholder to the project, all the different stakeholders are interested in how their interest aligns or competes with the other stakeholders' interests, whether it be the lender or the other owners, the sponsor, what have you. So a lot of the financial process and closing is getting all of those parties to work together. They're all at the table because they like the opportunity. Mm-hmm. They see that there are positive potential returns. They see that the sufficient risks can be mitigated, but they need to all reconcile all of their differences, and that's where all the engineering occurs.
Yeah. All right, so given that complexity, and given all the different players at the table that have to negotiate at the end of a project to be able to finance it, that increases the cost of a project. Right now, it's built into the cost or capital structure. What we're doing is, as another person in the capital stack trying to build projects, at Catalyze, which is my firm, we're trying to reduce those costs. We're trying to find standardization and eviscerate those things. And so we're doing that with the explicit intent to be able to lower the cost of renewables everywhere across the globe. So that's what we're doing as part of that. What do you see from your respective seats? What do we need to do to be able to get to lower cost renewables or 100% renewables globally and in the United States? Anybody can take it.
Sure. I mean, playing off the tax equity theme, I think we've taken it as a given that the way that Congress has, the way that in this country, one of the key ways in this country that we have essentially supported renewables is through the tax code. But for the policy folks out there, and one of the reasons I think this conference is so interesting is because people are thinking about that on the policy front, is it doesn't have to be that way, right? There are many countries out there and many states that do not, support renewables and support all these policy efforts through kind of the tax code, which essentially makes us do all these backflips that we've been talking about and that Joel was talking about. But rather it could be some other form of a feed-in tariff or a national portfolio standard or something that in my view anyway, would be a little more straightforward.
And I think policy is probably one of the largest ways to kind of scale the solar, but also, from our standpoint, we look at it as, how do you get it to non-investment grade businesses? How do you bring it to, the scale for people that aren't a Fortune 500 company or a utility that's buying the power? And so, we talk about community solar, and, it's been written about a lot, it's been talked about a lot, but it's just not being done a lot. And I think it gets to some of the issues
like
you were
teenage sex, or all right. Do you want to take a moment to do you want to take a moment to explain that? I mean, community solar.
Community solar, yeah, I'd probably do better at that. Yeah, describing that. So community solar is an opportunity for a developer to build a project and opens up ownership or participation in the solar energy for individuals who might not otherwise be able to access solar because they live in an apartment building or they don't have southern exposure or for whatever reason their locale isn't a good fit for solar energy. So they can subscribe to purchase their energy from an array that's centrally located and basically meter that against their utility costs. So the policy issue, every state's different though. So what the community solar you may have in Minnesota and the way it's getting done in Massachusetts or in Colorado are three wholly unique approaches to community solar. Would you agree with that?
Oh, yeah, definitely. I mean, that's because of the policy regimes that exist in the different states. And the fact that we've sort of had, as I mentioned in our preparation, my clients that come in from overseas and have experience overseas in renewables and are excited about the opportunity here in the U.S., anticipated they were dealing with one market and are upset that they really observed that we have 50 different countries and so many different regimes to operate in that vary to great degrees in many cases. To get back to your question, Joel, in terms of the you talked about two things of making renewables more adoptable, particularly solar.
Yes.
And you focused on what I think of as the deal friction, all the participants and the professionals and your companies working on that process with the software product, certainly. The other is just in terms of accelerating the adoption of renewables, lowering the cost of electricity generated by these, just to lower the individual cost of those different elements of the capital stack. Okay, the friction is something separate but incremental to those. And certainly lowering the cost is by providing more capital. If there's more of a resource, then presumably its cost goes down. And tax equity is one where we could use more tax equity in the markets. There was somewhere on the order of $12 billion of tax equity transactions in 2015, which is a record. It's projected to be as much as $15 billion in 2016, calendar year 2016. But certainly working with project sponsors, solar and wind developers, there aren't enough options out there. In certain segments, like the less than 20 megawatt segments for solar, there are very limited options for tax equity. So if, and the sort of the big policy statement here is, and it's sorry for this being really granular, but the SEC needs to tell the Financial Accounting Standards Board that they need to address how public companies need to report these investments in a more precise and favorable way. And then many more public companies
Is there a way to be able to get some social benefit from actually portraying that?
Well, there is social benefit, but you're not going to hit your EBITDA right. And for a company who's measured by Wall Street and whose principals or executives' bonuses are a function of EBITDA, renewable energy investing is generally not favorable.
And let me jump in real quick right there. And the reason is when you report this, you have to take losses above the line. So it looks like you've got a big loss on this project, and the benefits are called below the line. So unless you have an analyst that's following your company that understands what you're doing and realizes that there's a gross benefit to the investment that is not recognized very efficiently in this reporting system, you get dinged, your stock price. We have investors that have worked through us whose stock has suffered as a result of a renewable energy investment because of this function.
Despite the fact that they put solar farms and wind farms and the pictures in their annual report.
That's right.
Well,
right.
given that all those complexities, I mean, you've both listed mounting complexities in terms of additional reporting and additional negotiations that go into the final structuring of these deals, the ability to be able to go access more tax equity. I have to ask the question, is it really the most important thing that we need to be focused on, or can we find more efficient ways to be able to apply more finance to the renewable energy investment opportunity here in the United States?
I think there are a few tweaks to the code that you could make that would open up the market significantly on the tax equity side. Now, there are still limits to that. This tax equity competes against other tax equity classes. But if we were really going to blow the doors off, it would have to be some sort of federal legislation that really leveled the playing field. And we've been talking about that for some time.
Yep.
Yeah, I mean, I don't disagree. I just kind of thinking, trying to take it a little more meta, and I know we had a little back and forth on this earlier, Rod and I, but another option is to kind of say, okay, we as a society on the policy front are not going to support these projects with tax benefits. We're going to support them with cash benefits, making it much easier, and so we don't have to go into any of the kind of internal revenue code structuring. We don't have to open the book. So I'd love to get some pushback.
Where would
people
the
want
cash
to fight.
come from?
It could come from those companies that currently, as we're all saying, struggle to invest, right? We still obviously need to be out there marketing investments and kind of making investments increasingly attractive and making projects increasingly attractive. But I do think it would kind of mitigate those issues. Having said that, I don't see that happening anytime soon. I just put it out there for, again, as a potential policy change in the longer term.
All right. Well, so we can all agree that we have the system that we have, and we're making the most of that to be able to expand renewables in the United States. There are some limitations to that, but there are opportunities to be able to look at changing code, to be able to expand the amount of capital that's available at greater efficiency than what we have available today. Is that what I'm hearing?
Yeah.
Okay. All right. Cool. Well, check that box off. What I'd like to know now is, in addition to policy, what are the things that we need to see, or the things that you guys get the most excited about in the marketplace that are going to help us get to 100% renewables? We talked about technology, before we got in here. Do we want to talk about anything in addition to wind, solar, to be able to go help expand renewables? What's going to make that happen, Josh?
So I think Hank touched on it earlier, just as we were coming in. Storage, I think, is a big piece of the puzzle here. I mean, if you go and talk to utilities, one of the largest issues they have with renewables is the intermittency and the ability to integrate, solar and wind, which, as we all know, kind of the sun shines when it shines and the wind blows when it blows, and they don't always coincide with when we want to turn our lights on. And so, I think this is not news to most people in here, but storage in a big way, grid scale, with a lot of megawatts out there combined with renewables, I think, really is one of the technological answers that I'm excited about. And we're seeing it happen.
And it's such a fractured market, though. I mean, because there's, which technology is going to work the best. I mean, there's the low-hanging, the lithium battery right now, where plants are, built to produce and run, and that's where the investment's going to go short term. But the long term, I think on the storage side is there's going to be better technology solutions out there than what we have today. I mean, so I think that's what gets me excited. I agree it's energy storage. I just don't think the technology that we're using right now is going to be the technology that's going to be the most efficient in 10 years.
All right, I'm going to throw in one other piece of technology in that stack, which is we already have great trading systems to balance different regions of our electrical inputs and loads. They're called our independent system operators. They help us trade and manage the efficiency of generation with load. So I would say software and other capabilities to be able to intelligently put energy on the grid is probably going to be one of the things that helps compensate for the need for storage over the near term. But I still see storage as a great opportunity built into the stack that I'm excited about. What about the other thing that we haven't talked about in the financing stack, and what will help finance more is more offtake opportunities for renewables. One of the things that we need to do as developers investing into development opportunities is making sure that we have people willing to buy electricity at a rate that investors can come in and generate a rate of return. And so one of the big moves that we're seeing in the marketplace is the move of corporations into buying electricity directly through generating projects. Do you see that as a set of opportunities? And what do we need to do to get more corporates involved in this? I know that some of you have corporate investors, so what can we do to get them to invest more directly or take on more offtake directly?
Companies are attacking that. We see all sorts of different organizations. Not everybody wants a tax credit, but there are a lot of companies that want to go green. And one of the best ways to do it is to contract with a wind farm in Iowa and be able to benefit from that. One of the challenges is transmitting where the wind is to where some of these companies are.
Transmission and other technology.
Transmission is something we haven't touched on, but I mean that is an area that is worth a discussion at some point. But that market is actually booming from where we sit. We get asked that all the time. Where can I go immediately and directly interact with some sort of energy source that's green that I can claim as mine?
So my point of reference are certainly the smaller projects, so the non-investment grade, less than 20 megawatts, and it's really tough if they want to go solar, and because you look at them and it's easy to kind of underwrite a contract that Duke is going to buy all the power from your plant in North Carolina for 15 years. That's kind of like, okay, everyone has a horizon and can see Duke out there for 15 years, but when you're a regional player in a market, it's hard for a lot of financial institutions to really understand, what the secondary market of that is. So if they either build, in this case, build a wind farm or build a solar farm, what's the secondary use of that? And there's just a real lack of, for regional banks, a real lack of understanding at this time in terms of secondary uses and how to finance this. So I think that's, from a financial standpoint, as a bank, that's something where I think we need to look at ourselves and kind of get a little bit more aggressive in understanding as an industry of how these systems work.
Well, I heard the T word, the transmission word. Is that an area of investment that you guys get excited about, or is it something just we absolutely must have to be able to expand renewables?
That's a tough one. I mean,
Excited is a strong word.
Yeah. There's been so many discussions on that issue at the state level, at the federal level, and getting anything done has proven very challenging.
Well,
there's a recognition of the need. It's trying to get something done.
Yeah, so I've been really fortunate in that a lot of the developments I've done have been inside of ERCOT. ERCOT, which is Texas independent system operator, helped design a new transmission system just to be able to bring in renewable power from West Texas, 20 gigawatts of transmission lines, and they've continued to expand that since they originated that. And that's created a whole boom of development opportunities. The challenge I keep on seeing here is, there's a real opportunity here. I see what Clean Line and Mike Skelly are doing, finding interstitial opportunities in the marketplace to be able to bring in renewables. We see the Department of Energy trying to put some grants out there to be able to go spur this. We had a great conversation yesterday on the defense implications of building out new transmission and transmission security. It seems like there'd be a great set of opportunities. What do we need to do to open up the finance for that and to clear through all the different regulatory hurdles to be able to get there? I think that's going to be one of the things that helps us balance this. It's a critical technology, and it's what brings us our electrons that we need to be able to have here. How do we create a movement around this?
Well, isn't distributed generation part of the solution too?
Yes, it
though,
is.
Right?
Yes.
I mean, that's sort of, you were leaving that on the table. I know you were hanging it out there intentionally.
We have both. We have
Right.
distributed generation, and we
Right.
also have the remote, low-cost wholesale electricity that requires transmission. So.
Yeah. So, I mean, on the DG side, and Matt mentioned community solar. I mean, I think that's a great opportunity to, somewhere on the order of 60 to 80% of the rooftops in the country aren't suitable for solar, for example. So it's a great way for a lot of consumers or small businesses to access solar is through that. Yeah. And you mentioned adding off-takers, and that's certainly, it's not the traditional corporate PPA, the big Fortune 100 companies buying the electricity, but you have a much larger market than you do the Fortune 100 with community solar.
All right. So I'd like to open up now to audience. What questions do you have for our experts up here around how do we grow this? Over here.
Yeah, yesterday I presented an idea here from the conservative side about how to possibly spur financing to renewable energy and to all low carbon energy sources. It would be basically the application of Reagan-style tax cuts to clean energy. So instead of having subsidies, tax credits, tax equities, what you would simply have is a much lower tax rate on corporate income tax, on capital gains tax, state tax, dividends, and the other taxes that investors face, interest, for instance. And it would apply to all parts of the chain. So the people who make the windmills or the solar panels, the people who put up the project, the people who sell the energy from them. So there would be different ways that the different investors would look at it, but it would basically be a flat tax. I mean, it would be the same kind of tax for everybody, and it would be a simple tax cut. Would this appeal to investors? Would this spur investment by lowering the interest rates that the investors face? So that the idea is to increase the return on equity, so that if they sell the stock, or if they get the dividends, or if the corporation gets the profits, the return on equity looks better. So there's a lot of upside to it because it's not distortionary the way subsidies are, where you may be giving subsidies to businesses that don't really need it, or else they're failing businesses and maybe they shouldn't even get it because you're supporting failing models. But what do you think? Would this help investors?
Would streamlined tax code help out?
Yeah.
Well, go ahead.
No, I mean, I guess in my head, and maybe I'm missing a piece of it, but at least at the project level, when it comes to building, renewable energy projects, I see that is effectively what the investment tax credit and production tax credit do, in that for the owner of those projects, they effectively reduce that tax rate that they pay over the life of the project significantly. I'm with you in that, in the rest of the value chain, that doesn't necessarily exist. And so it would be great to have in the rest of the value chain, and I think would help spur some investment there, potentially around the margin. But where most capital is actually deployed, I kind of see that as, to be honest, happening already. I mean, via the ITC and PTC. I don't know.
Well, the ITC is a dollar for dollar reduction in your tax burden. And that's what people are buying, in part cash as well, and some losses and depreciation. But the accountant here, would you like to chime in?
Well, I mean, I think it probably does make its way, the tax credit makes its way through the rest of the value chain, because there's presumably, because of the tax credit, there's more dollars in that capital stack, more funding sources that might otherwise exist, which provide a revenue source for all those, the windmill manufacturer, whoever that might be, the panel manufacturer. So, I mean, I think the tax credits in effect are embedded in it. I'm sure there are simpler ways to affect the, what exists now in the code. I guess that was sort of a rhetorical statement, right? Just generally applies to the entire revenue code. It was an accounting joke because it was true. The code could be a lot simpler. We all agree with that. It was interesting because as I listened to what you were saying, and I'm sure I missed an important element of it, towards the end it sounded very similar to you were proposing a tax credit on the investors in these projects, which I think is what sort of Josh was reacting to. Right, okay. Okay, for all the participants, not just the investors. Yeah.
All right, any other comments?
Yeah, I mean, it lowers their costs, so theoretically, then there's more money available for these assets in some fashion, yes.
Great. Next question, over here.
Hi, Paul Droege here with Sunport. And before we had the ITC, RECs were actually a factor in financing renewable projects. It was before a lot of the financial engineering really began as well. And we've seen in states like Massachusetts and New Jersey where that's been a very effective driver of development in solar. And so I'm curious what you would say needs to happen to the REC market or the RPS market, the RPS requirements or something like that. What needs to happen in order to elevate the value of RECs to the point where we would actually see that be a pull for renewable energy, where there's demand for the renewable aspect of it, as opposed to today, where really renewables are essentially competing with other forms of energy on an equal basis, essentially, because RECs are essentially discounted or treated as gravy in the financial stack, as far as I understand. So could you please comment on what's going on with RECs, how big a factor they are or are not today, and what would need to happen in order for them to become a driver of renewable development?
I can't address the policy issue, but I will say that the RECs,
How you value them.
yeah, I mean, from that standpoint, you mentioned New Jersey, and it was a great driver, and then the bottom fell out, and then everything stopped. And, Massachusetts, they've gone through a series of stops and starts with SREC 1 and SREC 2, and we finance them. I mean, we look at it, but, we're not equity, so we look at a good contract, and we finance contracts. We don't take merchant risk, and that might be something that you guys
on
are
the
more.
tax equity side, we value them if they're contracted for the term of the contract. There's just not many of them around. And it's up to the states and utilities if they want to try to meet an RPS using this as a tool to help them. So without the RPS support, they don't really exist much.
There's
essentially no value to them today.
So I actually disagree. I disagree with pretty strongly, especially in some of the solar rec states. So Massachusetts and New Jersey, you mentioned. Massachusetts, projects have gotten done there. Massachusetts does not have great solar irradiation. And the reason projects have gotten done there is because of the value of the SRECs. Now, would we as kind of financiers like to see more, and investors like to see more stability there in that market? Of course, right? And especially what happened in Jersey is instructive of what happens when there's instability from the regulatory side. But I actually do think that there's tremendous value. And when we look at a project in Massachusetts, for instance, and in Jersey even currently for that matter, we value the RECs significantly. And to Rod's point, much more heavily if they are contracted. But we will still give them value even if they're merchant. It'll be a haircut value, but there will be value there.
Great. Well, I was hoping to be able to squeeze in another question. I think we're running out of time, so I'd like to take this moment to say thank you to each and every one of our panelists who have been fantastic and have been innovators, and I look forward to continuing to see innovation from them in the financial investment space for this. So thank you.
Thank you.
Thank you.